we're going to be maximizing tax benefits. And in in network marketing, the IRS defines a business as a, now what was that hidden, honey?
It's hidden.
It actually defines a business as something that's generating money or is expected to be making a profit. So what my boss is going to discuss, and my tax pro for over 20 years, as far as the taxes are concerned, is going to show you how you can deduct like a pro to keep money in your pocket as opposed to giving it away. So I'm going to switch seats with you.
Okay. Okay. Well, this is falling off. Okay, we're going to touch on a few different aspects of a tax return for small business owners. One is your income. One are your deductions, credits, and allowances. And the third is your tax liability. Now, I know we got a lot of information going on, so take a lot of notes, snap some pictures, and if you have any questions, we'll answer them at the end, if time allows. If not, you're more than welcome to call us, and I'll guide you through any of it. First of all, your types of income. Everybody that has generated over $600 is going to receive what's called a 1099 NEC. That stands for non-employee compensation, and that'll come to you directly from LifeWave. Now, that 1099 NEC is going to include all of your commissions. It's also going to include your profit from your preferred customer programs and any bonuses that you generated. Now, the second type of income is your retail sales. This is the cost only of the product you sold in the field. If you sold a sleeve of X39 for $150, that is a retail sale. The best way to keep track of that is get yourself a little, what do they call it? A little sales receipt book that duplicates the receipt. Give the initial receipt to your client, and you keep the copy. That's your record of your retail sales. Now, there are other income that you receive. For example, payment you receive from other brand partners towards a vendor event, maybe a luncheon, if 2 or 3 of you pitch in together. For banners, the person that paid for that banner is going to write the full cost of it off, but the other two, that person will have to claim whatever the other brand partners contributed towards that cost as income. Okay, it could be meeting expenses or any other expenses that other brand partners contributed to. Now, this income will be offset by the actual receipted expense. Again, receipted. IRS is all about receipts. So if you contribute money to a luncheon, okay, the person you paid that money to will claim it as income, but you will get to write it off as an expense, a business expense. And the person that collected the income, that income will be offset because that person is going to write off what they actually paid for that luncheon. Okay, how do I get to the next one? All right, now we're going to talk about different deductions, credits, expense allowances that you're allowed to claim on your return as a small business owner. Okay, They're categorized. So what I suggest to my clients is that you invest $20 or $30 into what's called an accordion file. Okay. It looks like a box, opens up like an accordion, and has slots in it. You're going to put a file folder in each one of those slots and write the category of those expenses. In other words, you would start one that says advertising 2024. And I'll tell you why in a little while. We're going to do the files. Now, everybody comes and they'll say, well, I don't advertise. I don't put any ads in magazines, TV, radio, online, newsletters, and so forth. But every time you hand out a business card, you are advertising your business. Anytime you participate in an event, a patch party, a business presentation, and you put up one of those pretty banners that displays our business or our product, that banner is advertising your business. Now, logo printed clothing. Okay. I bought this little jacket at convention. It has a LifeWave logo on it. I love it. It's comfortable, keeps me warm. But because it has the logo on it, I can write what I paid for this little jacket, write it off 100%. There are promotional items such as mugs, hats, t-shirts, pens, and other things. I remember, I think it was last year, LifeWave gave us a pen that had LifeWave written on it. You may want to do that for your business, to hand out to prospects or to distribute at events. Now, your business and or your product brochures that you either have printed up or that you buy directly from LifeWave, you are handing those out. You are advertising your business again. The cost of setting up and operating a business website. I know that Ed knows how expensive that can be. Okay, but that expense is also tax deductible. Now, this is something I want to touch on for a minute. Promotional products, the products you use to demo with. I'm going to give you an example. David and I had the pleasure of having dinner last week with Ed and Vicky at a restaurant, and our waiter came to the table. Don't you know Ed's going to patch everybody he comes in contact with? Well, he did. He talked to the waiter, asked him if he had pain. The answer was yes. And he asked him, would you be open to allowing me to show you a technology to relieve you of that pain? Of course, the waiter said yes, and Ed patched him. And I believe he used an Aeon and IceWave. Now, that is 3 patches. If you take the cost of a sleeve of patches, let's say $60, okay, we know there are 30 patches in that sleeve. Therefore, each patch has a value of $2. So that Aeon and the 2 IceWave patches totaling $6 of value, you do not include, that's important to know, the what you pay for taxes or shipping in this, because this is a promotional product. But that $6 is a tax deduction to you. That may not sound like a lot, but if you've patched 100 people over the course of a year, then you've got now promotional products of $600. Now, because this is an election year, there's a note that I want to go over with you. You cannot deduct the cost of any advertising in any publication or website used by or for a political party or candidate. That is totally against the law and not allowed. Okay. This is huge. Our next category is vehicle expenses. The most important thing to be able to claim expenses incurred for your car is keep a business mileage log. You have to be able to prove the amount of miles driven for each business related trip. Now, included on your log, there needs to be certain things. Okay, date and time. The time's not so important, but the date the trip took place, whether it was local or long distance. The name of a business you may have driven to. For example, you drove to the office supply store, you had to buy printer ink. You went there for a business purpose. The name and address of a person you may have gone to meet. Any related purpose for traveling to meet, for a related purpose for traveling to the destination. In other words, I drove maybe to Mary's house because I wanted to patch her and share with her our business presentation. David may have driven to Ed's house, Ed and Vicky's house, to pick up some product. Or you may have driven somewhere to deliver product. You want to jot that down. Now, this is huge. Miles driven while on business travel. For example, if like David and I did, we drove from Texas to Florida for the convention. And because we did, we drove, I want to say something like 1,200 miles.
Yeah.
Something like that. Okay. Okay. There are two different methods that you can claim your vehicle expenses. Okay. It's necessary to have that mileage log for either one. First of all, you can claim actual expenses, or the simpler method is your standard mileage rate. These are some examples of actual expenses that you can include for your deduction. Maintenance, for example, oil changes, repairs, tires, windshield wiper blades, title licensing and registration fees. You can depreciate your vehicle. Now that's based on the date that you placed that car in service for this business, as well as the cost of the vehicle. It's a great deduction. Your insurance cost, your auto club dues. For example, AAA, if you have AAA, those are tax deductible. Your gas, parking fees, tolls. Now, if you're not buying your car and you're leasing it, you get to write off a percentage of those lease payments. If you're buying your car and not leasing it, you write off the interest on your auto loan. You take your car to and from car washes. If you're driving a prospect to a business presentation, I'm sure you want your car to be clean. You're going to write that cost off. Also, towing charges. Go ahead. Now, remember that you have to keep a business mileage log. Okay, we already did this screen. You went the wrong way. The other way, babe.
I don't know what's happening.
I don't either, but let's try it. Sorry, bear with us a second. I got it.
You did that one.
Okay, now, when using actual expenses, a percentage is calculated of the deduction that you're allowed. And I'm going to go over this little example with you. Okay, let's say you have 10,000 business miles and you have 5,000 commuting miles. And commuting miles are miles that you have driven to and from a W-2 job. You have personal and other miles. That could be driving to the grocery store, taking your children to school, driving to church, driving anywhere other than to your job or for your business. So let's say hypothetically your total miles driven are 20,000. Now, the number of the business miles that we're showing is 10,000. That is 50% of the total miles that you've put on your vehicle for the entire year. So all of those expenses that we just talked about, 50% of the total cost is tax deductible to you. The second method is the standard mileage rate. Now, beginning January 1 of 2023, the standard mileage rate for the use of a vehicle for business is 65.5 cents per mile. So we're going to go back to those same 10,000 business miles driven. You multiply that by that 65.5 cents per mile, your deductible allowance is $6,550. That's huge. Now, there's a little note down here because this is very important. If you select actual expenses in the first year that you put your vehicle into business, you are required to continue to use this method for that particular vehicle in future years. However, if you use the standard mileage rate in the first year of business, you can choose to switch back and forth between methods from one year to the next. Now, there's a benefit to that, but remember, you have to start year one with standard mileage. Let's say we did standard mileage, we got our 6550 for the first year. Now, in year number two, oh no, you had to replace a $7,000 transmission and maybe $400 or $500 for brakes, and you had to buy new tires. Well, now you're looking at maybe $8,500, $9,000 of expenses. So you know that for that year, you're going to want to switch to actual expenses. You always want to calculate your vehicle expenses both ways, or have your tax preparer do that. And if you don't suggest it, I guarantee you they're not going to be happy about doing it on their own, but you're paying for a service and you're entitled to that. You want to be able to reap the benefits of the higher deductible allowance. But remember, in order to switch, year one has to be the standard mileage rate. Oops, I think we skipped one.
Yeah.
Okay, we're going to talk a little bit about depreciation. We have depreciable assets. Every one of you do. How I know that? Okay, they include a computer, a laptop, a tablet, an iPad. I know that you've all bought a cell phone, a printer, any other electronics. If you have an office in your house and you've bought office furniture and fixtures, you need a lamp to put on that desk. And again, you get to depreciate your vehicle. Insurance. Business and liability insurance for your venture is 100% deductible. Now, health insurance is deductible if your self-employed coverage is paid out of pocket. Now, if you have a W-2 job and you're paying part of your health insurance coverage through your job, that is not deductible. Only your self-employed coverage that is being paid out of pocket, that will be 100% deductible. Next category, and remember, we're making files for each one of these categories. Your legal and professional fees. Fees paid to lawyers. Well, what in the world do I need to go to a lawyer for? Let's say you want to develop a different structure, an entity structure. You want to take your sole proprietorship and you want to convert it to an LLC and maybe take an S corporation. There's a benefit to that, and we'll go over that. You do not want to attempt to do something like that on your own. You're going to go to an attorney for that help. Those fees are deductible to the attorney. Fees to accountants, bookkeepers, financial professionals, tax preparers, and your fees for online booking services are all tax deductible. We're going to talk about supplies. This is simple. Basic office supplies, pens, paper clips, staplers, binders, supplies that you purchased for use at a vendor event. This is where you would deduct any supply purchased that is not included in your office expense section. And we're going to go over that. Taxes and licenses. Taxes paid on all product order purchases. Okay, we all get those receipts when we receive our orders. We have an invoice, and on there it shows the amount of taxes. We're going to add those up at the end of the year. We're going to write those off as taxes paid to LifeWave. And this is why we're not including the cost of taxes and shipping in our promotional cost. Subscription fees for bookkeeping programs. Let's say you want to maintain all year your books, you buy QuickBooks. That also falls into this category. Oh. Okay, now we're going to go over office expenses. Postage and shipping expenses includes FedEx, UPS, USPS, and all the shipping you paid to LifeWave. Again, you'll find that on your LifeWave invoice. Whatever you pay for shipping materials, whether it be boxes, envelopes, tape, bubble wrap, or anything. Copies. I know that when I was in Florida, Elsie and I went. Elsie needed to make copies for a doctor that she was prospecting. It was awesome. Those copies were very expensive because she wanted them in color and they were beautiful. The cost of those copies became a tax deduction to her. If you have to buy computer accessories, if you have to buy, give me a computer accessory, a new mouse, or any kind of computer accessory, printer ink, your paper, Zoom fees, website services, computer software, if you pay for domain names, merchant fees. And I'm going to stop here for just a second because when you do certain events and you use your phone, what is that called? When you take payments.
Square.
Square. If you have to pay fees to Square and any expense related to the operation of your business goes in under office expenses. Next category, rent or lease expenses. Rental cars, and I have local use on here for a reason. Let's say your car breaks down, you're in a rental car for 2 weeks. You're going to write that rental fee off. Rental equipment. Well, you know, we're in a patch business. What kind of rental equipment do we need? I'm going to give you an example. You rented a hotel room for a business presentation. But if you want to use their television to play a video, they may charge you a rental fee for that equipment. And then the actual cost of rental property. As your business grows, you may want to take it out of your house and rent an office space. Or again, You may rent a meeting space, a hotel room, a presentation room. That all goes under rent or lease expenses. Talk about travel expenses. I know we all had that. We went to the convention. Airfare, hotel, parking, vehicle rental during travel. If you flew down to Orlando, you needed a vehicle to get around, you rented a vehicle, that goes under travel expenses. Train and bus fares, taxi, Uber, and Lyft fares, or any other transportation between an airport or a train station to the hotel that you're staying at. Also, from the hotel to the location of the meeting or event. There is mileage involved there. Now we're going to go on to meals. Now, meals while meeting with someone at a restaurant for either business introduction or product introduction. Unfortunately, in 2023, it dropped down to 50% of the actual cost because IRS feels like you're taking someone out, but no matter if you're out or home, you have to eat, so you can't write your own meal off. You get to write off 50% of the cost of what you just spent at that restaurant. Now, on the flip side of the coin, food and drinks, and of course they have to be non-alcoholic, served at trainings, at in-home presentations. If you're conducting a patch party, they are deducted as event expenses, and that allowance is 100%. Now let's talk about utilities. Any utilities that are not being deducted under what we call the home office deduction, and I'll explain to you why, are deducted here. For example, we have an online business. We are required to have the internet. Some of us may have a separate phone for your office. Those are deductions that you would file under utilities. We have other expenses. Now, remember I talked about depreciation, and the cost of a new cell phone is depreciated, but that does not include the cost of your cell phone service. So you pay a monthly fee to T-Mobile or Verizon, whomever, okay? You can deduct the business use cell phone service fee, cost of your convention tickets, vendor fees, bank fees, and any expense that you've incurred that is not categorized in the categories that we just went over. To give you an example of that, if you have preferred clients, you know it's their birthday and you'd like to gift them something out of your business account, not personal. This doesn't mean that if you buy, your kids or your family Christmas gifts, you can write them off, but you can write off a gift up to $25 per person to your clients. Or another example would be, unfortunately, David and I lost one of our brand partners, and we purchased a flower and had it sent to her viewing. That is tax deductible because it was business related for a business partner. Now we're going to talk about business use of home. Now, two rules apply. First, the home office deduction is only allowed after all your expenses have been deducted from income and the bottom line is still showing a tentative profit. If you have reduced your income, if you have made, let's say, $20,000, but you have $22,000 of deductions, now your business is at a $2,000 loss. This deduction does not apply because the IRS does not allow it to increase a loss. The second rule is that the home office must be used regularly and exclusively for business. That's crucial. Now, to calculate this deduction, you need the square footage of your home and the square footage of your office space. What you would do is take that square footage of your office space and divide it by the total square footage of your home. This creates a percentage, okay, that can be deducted. So let's say, for example, I don't have my calculator in front of me, but let's say you've got a 400 square foot office area and your house is 2,000 square feet. Okay. What does that give us? A 20%?
Yeah.
About a 20% allowance on all of the expenses that have been created in your home. The second way you can do this calculation, if the number of rooms in your home are of equal size or close to equal size, you can calculate this percentage by using the number of rooms used for the business regularly and exclusively. An example of that, let's say you have a living room, you have a kitchen dining area, and you have 3 bedrooms, and you've converted one of those bedrooms into an office that you're using regularly and exclusively. That is 5 rooms. We do not count the bathrooms, whether you're business or personal. Everybody uses the bathroom, okay? So now we've got these 5 rooms that are of similarly in equal size. One of the 5 rooms is your office. So if you've got 20, 40, 60, 80, 100%, 20% of all expenses will be deductible. Deductible home office expenses include your mortgage interest, your property taxes, homeowners insurance, flood insurance. If you have to pay HOA fees, all of your utilities, your gas, your electric, if you buy oil heat, your water, all your cable internet, all of your utilities. If you have a pest control service, landscaping or lawn service, cleaning service, home security systems, repairs and maintenance. And you also get to depreciate a percentage of the value of your home. Now, if you rent your home and you don't have interest and so forth, then that same percentage of your rent is tax deductible. Okay. There was something I wanted to touch on something. Let's get back to repairs and maintenance. Let's say you're at that 20% calculation and you have to replace a $10,000 air conditioning unit. Well, that alone is going to give you a $2,000 tax deduction. If you replace the roof on your house, 20% of that cost. If you have to replace plumbing, pipes, whatever, if you do a renovation in your home, we have 20% of all cost being deducted, even if it doesn't directly happen in your office. Now, you have to remember something. There are many allowed business deductions available to you. IRS requires documentation, receipts, most importantly, mileage logs to back up every expense documented on your return. If you can't provide these documents, do not claim the expense as a deduction. The reason I suggested an accordion file with folders in it categorized, okay? Again, advertising, supplies, vehicle expenses, home expenses, and so forth. At the end of the year, you will have your receipts already separated for you in these folders. When you take the folders out of your accordion file, you total them up. Those are the numbers that go on your return. When the return is completed, you want to band those files together and write on there they are for tax year 2024 or so forth. You take your actual tax return and you band that right on top of your receipts. Why is this a good idea? The general public can be audited for 3 tax years, but as a business owner, IRS can audit you at any point in time over the next 7 years. Now, I don't know about you, but 7 years from now, I'm not going to remember what I spent as a supply or an office expense. But by you having those files put together, if you were one of the unfortunate ones to create an audit, all you have to do is take those receipts, the files as they are, and your return and hand them over to Internal Revenue. You'll have everything you need to back you up. Okay, we're going to touch base just for a minute on your tax liability. They're a little bit different, taxes paid by self-employed people. First of all, you're going to pay federal taxes based on your income tax rate. And right now there are 7 different percentages. If you live in a state that has a state tax, you're going to pay state taxes as well. In addition to that, on your state return, for example, in the state of Maryland, there's also hidden on that return a local tax that you pay in addition to state taxes, depending on what county you live in. So that's a lot of taxes right there. But now, as a self-employed person, you have to pay self-employment taxes. And they're generally based on about 92.35% of your net self-employment income. The self-employment tax rate for 2023 is 15.3%. Now, a lot of people come in and they say to me, Lynda, why do I have to pay self-employment tax? Well, it's just, and they think that it's just another tax to the government. In actuality, 12.4% of it is your contribution to Social Security, to your Social Security account. 2.9% is your contribution to your Medicare account. So I have others that come in and they say, well, I'm already collecting Social Security. Why should I have to pay this? At the end of the year, your self-employment taxes will be sent over from IRS to Social Security Administration. Your account will be reevaluated, and the money that you've put in for that tax year will be divided by 12 months, and your Social Security payment will go up. The 2.9% is your contribution towards your Medicare health coverage, and we all need health coverage. So that's not an issue. Now, there are ways there are some people that come back and say adamantly, I don't want to pay self-employment. How can I get out of paying that tax? And there are ways that you can. You would actually have to structure a different entity for your business. You could form what's called an LLC and take an S Corp election. Now, that may sound confusing, but it's really not. It's not something you want to do on your own. You probably want to go to a tax attorney for it. But what that does is it turns your business, it's like a conversion. You're no longer a sole proprietor. You become a limited liability company, which, by the way, protects your personal assets. And that company, by electing an S corporation election, which means that for tax purposes, you want to be taxed the same way an S corporation is taxed, you do not have to pay self-employment taxes. However, the income generated in that LLC is passed, it's called a pass-through entity, and it passes down to the members of the LLC. It could be two of you that are partners, for example. And let's say there's $100,000 of income. Each one of you would get something called a K1, indicating that you generated $50,000 of income from the LLC. However, now all the deductions that you were able to take as a sole proprietor are not available to you because you're being taxed your federal and your state taxes. Okay. At this point, I hope I didn't confuse everybody. If you have any questions, David and I will both be happy to answer them. And I want to thank you for participating in tonight's meeting.